Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line again Sheryl Moore. In our last call, Sheryl actually talked to us about how she got into the annuity space, which is fascinating, and you should check out the first video. But Sheryl, thanks for joining us again.
Thanks so much for having me, Mark.
Okay, so tell us a little bit about your background. Again, how did you get into the annuity space? How long ago was that?
I've been doing this for a little more than 20 years now, and I don't endorse any company or product at all.
Okay, very cool. So your company, it does competitive analysis. So what exactly do you guys provide as part of your offerings?
Well, I would say in short, I read all of the annuity contracts and the life insurance contracts, but we have a website at winkintel.com where we have this massive database of life insurance and annuity products that people can search on to find, for example, what is the product that is in my client's best interest? Or what type of annuities or life insurance products does my competing insurance company offer?
Okay, so you're like the expert's expert working with the advisors and the home office to help them help their clients.
Absolutely.
Okay, so today I know our theme, we wanted to talk about the myths of annuities. And I found this to be fascinating because as a long-term care expert, it's a very similar, the myth structure actually. We see some, shocking similarities there. But let's start off with what's the number one myth that you run into, when consumers contact you or advisors contact you about annuities in general?
Annuities are expensive. That's the number, hands down.
Right.
And
That's funny. That's the same number one myth about long-term care. Long-term care is expensive, and it just depends on what you actually buy and what you design, right? So tell us a little bit about why that myth exists and what you think about it.
Well, I think that the biggest reason that myth exists is because historically, the top type of annuity that has sold is variable annuities, which actually are a security. The people who buy them can have unlimited upside based on the market's performance, but they can also have unlimited downside. And some of the different riders and benefits that are on those products have fees, as well as some of the sub-accounts that are offered on them. So historically, when the press is writing about annuities, what they really mean is variable annuities, which are just one type of annuity, and that product does have fees that are associated with it. Where, if we were talking maybe a fixed annuity or a multi-year guaranteed annuity or even an indexed annuity, those products don't have fees that are associated with them, except there has been some new development over the past decade where there are optional features which may have a fee, but we're talking a difference between, variable annuities may have fees as much as 4.5% annually, and these other types of annuities don't have fees unless there's an optional feature, and that optional feature might be 1% annually if you elect it.
Right. And, as an actuary designing these products on the long-term care side, it's similar on the annuity side. What you're really trying to do is you're incorporating all the costs, and each of those different riders have a different cost structure associated with them. And frankly, over time, as these other annuities have become more popular, right, of like the indexed annuities, the MIGAs that you said, the multi-year guarantee annuities, that may actually not have as much cost or risk to the insurance companies. A lot of that savings get passed on to the consumer. So it's really about what are you buying, and it tends to be a relatively efficient market where if you're buying something that's not as expensive for the company, it's not going to cost you as much either.
Yeah, I like to equate it to, a risk return spectrum where the lower the risk, the lower the potential for gain, the lower the cost.
Okay. So we talked about the cost of annuities. A lot of it also has to do with how much benefit you're buying too, right? You could buy probably a pretty low cost annuity that doesn't provide as much. Let's say you're buying an income annuity, guaranteed income for life. Or, if you're buying a deferred annuity, isn't going to have as much cash accumulation. So it can really fit the needs of your client's budget, correct?
Right. I mean, there's so many different choices, and the price or what the cost is going to vary between those choices.
Okay, and I know the overlying theme of this is if you go to somebody who's really an annuity expert and you tell them, here are my needs, here's what I'm looking to spend, they can figure out how to maximize the value for your dollar. That's kind of the bottom line.
Absolutely. I mean, they need to do some fact finding and find out, what things are important to you. So, for example, if I don't have a spouse, I may not want payments to last the longer of my life or my spouse's life, which would be a more expensive option relatively speaking, than just getting payments for the rest of my own life.
Right. Okay, so let's talk about the number 2 myth. What would you say is the number 2 myth that you come across in the annuity space?
Once I buy an annuity, my money is locked up. You can't access your money. Annuities don't have liquidity.
Okay, and so what's the reality of that? What are the options that annuities have that provide liquidity for consumers?
Well, we've got income annuities, which would be like annuitization, SPIAs, DIAs, and then we have deferred annuities, which would be like fixed index, multi-year guaranteed, variable, and structured annuities. And when it comes to income annuities, there really isn't a lot of liquidity because it's basically an irrevocable decision to get paychecks for the rest of your life, and you can't modify the amount. But when it comes to deferred annuities, there's actually a lot of liquidity. Most deferred annuities allow the client to take out 10% each year without a penalty. Most of them pay the full account value to the beneficiary upon death. Most deferred annuities have surrender charge waivers, which would waive any penalties in terms of surrender charges in the event the annuitant became disabled or confined to a nursing home or had a terminal illness, or even some that say you can get, access to your money if you become unemployed. So then that doesn't even touch on all the different rider options and ways to get income through guaranteed lifetime withdrawal benefits, et cetera. So deferred annuities actually have a lot of different options for liquidity, which most people don't realize.
Right, and I think what this comes down to is the products themselves. There's so many different options. This is a good thing. There's innovation going on where consumers have choices, but because of the complexity there, you really do have to do a lot more research today. Luckily, there are people like you that are going out there advocating. I actually learned about annuities by going on YouTube and listening to annuity experts and learning the difference between deferred annuities and income annuities, for example, on YouTube. So I know a lot of the topics we're talking about, if you're not familiar with this marketplace, definitely do some research. But again, really the theme of this is there are people out there that are experts in this and can help guide you in the right direction. Let's talk about the third myth, number 3 myth. What would you say that is that you get questions about?
Well, it's normally if I buy an annuity and I die the next day, the insurance company keeps my money.
Okay. So, there's this, again, you are paying for that benefit, that guaranteed income component, for example. But what's the reality behind that myth? What are your options?
So you know how I talked about income annuities and deferred annuities?
Mm-hmm.
So income annuities normally give you about a dozen different options for taking payments. And one of those dozen options is just give me payments until the day I die, which means if I die tomorrow, there's no more payments and the insurance company does keep the money.
Right.
That means there's also close to a dozen other options where your beneficiaries or your spouse would receive income even though you had passed away. And on deferred annuities, actually the insurance company doesn't keep the money on those when you pass away. Your beneficiary gets the value when you pass.
I got it. So there's one case study where that myth is true, and then there's a whole host of other ones where it's not. What would you say is the most popular annuitization option that consumers choose in practice?
I would be guessing it's a, life and period option, let's say 10 years or 20 years. So I want payments for the rest of my life or at least 10 years or 20 years if I die before that period.
Right, and that provides you that minimum cushion where if you die tomorrow, you still get that a benefit to your beneficiary.
Right. And that payment would be lesser than if you chose to just do it for the rest of my life, because there is a greater risk to you as the purchaser that you would die tomorrow. But I like to say, you're getting what you pay for there. There is more risk, and for that reason, you would have a higher paycheck if you chose life only.
Okay, well, I really appreciate your time sharing the myths of annuities. I'm sure we're going to have you on more to discuss other topics in the annuity space and hopefully demystify, some of the misconceptions out there. So thanks for sharing with us today.
Thanks so much, Mark.